All right, today we're jumping headfirst into the world of startup funding. It's one of the most high-stakes games in business. But let's be honest, it often feels like a total mystery. We're going to uncover why it's so incredibly hard to get money, who actually has it, what it really costs you, and maybe the biggest question of all, is the massive risk even worth the reward? So picture this. You have that lightning in a bottle moment, the idea you just know could change an entire industry, maybe even the world. You're sitting on a true billion-dollar idea. But here's the reality check. Even the most brilliant idea on the planet often starts right here, with a personal bank account that has, well, nothing in it. So how in the world do you bridge that gap from a great idea and an empty wallet to a real, thriving company? You need funding. Getting that funding, though, is notoriously difficult. And it's not just about finding people with deep pockets. As we see in a ton of corporate finance research, it really boils down to two fundamental problems that every single entrepreneur has to solve. Okay, so problem number one is something academics call information asymmetry. Look, you, the founder, you live and breathe this idea. You know its potential, its quirks, its secret sauce. An investor, though? They're on the outside looking in. They're trying to figure out if your genius idea is actually genius, or if it's a total dud. And that knowledge gap, it's a massive hurdle. And second, even if an investor does believe in your idea, they're staring down the barrel of moral hazard. This is all about trust. Once they hand over that big check, how do they know you're going to use the money to grind it out and build the business, and not, just lease a fancier office? They're taking a huge leap of faith on you. So solving these giant problems of information and trust, it takes a special kind of financial backer. Let's meet the key players who actually make this whole high-stakes ecosystem work. In the early days, you've basically got two main sources. First up, you have angel investors. These are wealthy folks investing their own money. They're the ones writing smaller checks for super young companies, sometimes before there's even a product. On the other side, you have venture capitalists, or VCs. These are the pros, investing other people's money from a giant fund. They usually come in a little later and write much, much bigger checks. But here's the thing about VCs. They do a whole lot more than just wire your money. They are incredibly active. Research shows they visit their companies about 19 times a year on average. They help turn your scrappy startup into a real business. They recruit top talent. And yeah, they have the power to replace the founder. Their investment is also like a stamp of approval that tells the whole world your company is the real deal. Of course, getting that kind of cash and hands-on help, it doesn't come for free, not even close. It comes at a really steep price, one that's spelled out in the incredibly complex contracts that founders have to sign. The VC's favorite tool, their weapon of choice really, is something called convertible preferred stock. It's used in over 95% of deals, for a reason. You can think of it as giving the investor the best of both worlds. If the company fails, their stock acts like a loan, so they get paid back first. But if the company hits it big, it converts into regular stock, giving them a shot at that massive upside. It's a safety net with a rocket launcher attached. VCs also don't just hand over all the cash at once. That would be way too risky. Instead, they use staged financing. It's basically like a startup's allowance. They give you just enough money to hit your first big milestone. If you nail it, great, you get your next chunk of funding. But if you don't, the VC can just walk away and cut their losses. It's a huge lever of control. And believe me, the control doesn't stop there. VCs demand seats on your board of directors, sometimes enough to get a majority vote. They put in clauses to protect their ownership from getting watered down later. They even control the founder's own shares through vesting schedules, which means you have to stick around for years to earn the stock in the company you started. So, all this brings us to a classic dilemma. Let's put you in the founder's shoes. Imagine you get two offers. Offer A is from a good, solid VC. They value your company at a cool $10 million. Offer B is from a legendary, top-tier VC, one of the best in the world. But they value you at only $8 million. So you get to keep more of your company with offer A. That seems like a no-brainer, right? More money, more ownership. So which deal do you take? You might be shocked to hear this, but tons of research shows that entrepreneurs very often take the lower valuation. Why on earth would they do that? Because they're not just selling pieces of their company. They're buying a strategic partner. And the network, the expertise, and the credibility that comes with a top-tier VC can be worth way more than the extra equity. Okay, so let's zoom out for a second. The success or failure of a startup isn't just about the deal it makes in a boardroom. The entire ecosystem is shaped by these huge, sweeping forces, like public policy and the health of the stock market. And that funding environment can be wildly volatile. I mean, just look at the money flowing into VC funds. You had this absolutely insane spike during the dot-com boom in 2000, followed by a collapse of nearly 50% in a single year. The cash flowing to startups isn't a steady river. It's a total boom and bust cycle. And you know what a huge driver of that cycle is? The public stock market. A healthy market allows a startup to have an IPO, an initial public offering. For the VCs, the IPO is the exit. It's their payday. But for the founder, it's something more. It's often their first chance to finally buy back real control of the company they poured their life into. So, this all leads us to our last and maybe our most important question. After all of this risk, after giving up so much control and navigating this completely unpredictable market, is it actually worth it, financially speaking? I mean, really think about it. Does taking on the incredible all your eggs in one basket risk of starting a company actually pay you more than if you had just invested your money in the stock market? And here's the answer, which is kind of a bombshell. Study after study has found that, on average, the returns on private equity, on startups, are no higher than the returns on public stocks. This is what's known as the private equity premium puzzle. Despite all that massive extra risk, there's often no extra financial reward to show for it. Crazy, right? Which leaves us with this one big lingering thought. If entrepreneurs are taking on all this risk for returns that, on average, don't even beat the market, what's really driving them? Maybe it's not just about the money. Maybe it's about building something from nothing or having control over your own destiny. If the data says it isn't purely about the cash, then what is it really all about?